Good morning, everyone. On behalf of 360 Wealth, it's a pleasure to be hosting this knowledge series with you all today. We'll be touching upon diverse subjects spread across 3 sessions. 361 Wealth, as you just saw in the video, formerly known as IIFL Wealth, is India's only publicly listed wealth and asset management firm. We manage close to $41 billion of assets under management. A quick introduction to myself. I am Akshat Saraf, based out of Bangalore. I'm a partner with IIFL Wealth, and I've been with the firm for the last 9 years. Before IIFL Wealth, I've also worked with Goldman Sachs in the private wealth division. The first session, which will be taken by Rama Biani, who's a senior partner taking care of key clients group. We will be covering the basics of investing, which we have called Investing 101. Basic hygiene practices with respect to managing investments, behavioral factors which play an important role. This subject is very personal indeed, and they have multiple moving parts. But what we'll try to focus on is how processes, discipline, and patience play an important role. Quickly to introduce Rama, as I mentioned, she's a senior partner with us. She has been with the firm for over 6 years, and she has over 18 years of experience on the financial sector side. Before IIFL Wealth, she's also worked with Standard Chartered, RBS Private Banking, and she's had a 9-year stint with RBS and with Tata Capital Birla Sun Life in the distribution roles. Rama, over to you. Please take it forward.
Hi. Thank you so much, Akshat, for the kind introduction. Good morning, everyone. I know Saturday morning, it's difficult to get into a call, and that too when it is on the investing and financial markets, but we'll try and make it slightly more interesting. I think I've got about 30 odd minutes, and in the next 30 minutes, I'll just try and touch upon some of the important, aspects or attributes of investing. Let us understand that what are the important things that we need to really know before we, start planning for our investment. And that is something which can give us a long-term sustained returns. So I'm just going to share my screen. Actually, when you see it, just let me know, please.
Yes, it's visible.
Yeah, I'm just making it full screen. Just give me a minute. Okay, so let me start with the interesting quote which George Soros has given, which says that if investing is entertaining and if you're having fun out of it, then you're probably not really making any money. And the punchline of this quote is, good investing is boring. And believe me, this is actually a fact, because since last 2 decades, I've been closely tracking markets, investing into markets, recommending and advising clients. And what we've seen is that over longer periods of time, what actually makes money to you is something which you buy and let's say hold on for longer term. And that is what actually something which doesn't give you a lot of excitement. It is boring, but yet that is the portion which can actually make money to you. So before we get into the financial investing, let us just understand in terms of your net worth, what are some of the key components, which comprise of your net worth? So one, it could be your business assets. Second, obviously, we understand that a lot of Indians, have investments into real estate, and which also essentially part of your net worth. Third could be your personal assets, which could be in the form of jewelry, watches, or let's say, any personal assets that you try and sort of create for yourself. And the last part, which is the topic of discussion today, is the financial assets or the financial investments. So before we get into financial investments, just let us look at, what are the key components of your financial assets. So essentially, one can actually break it into 3 parts. First, if you see what I've put here is the safety pod. Now we know that for every investor, it is very different. When we look at investments, one can say that I need some part of my investments or my savings into creating a safety pot, which can help me in my long term, or let's say after my retirement, and that money is available at any point in time if there is any need which arises either to me or to my family. So generally what we see is that especially the HNI clients, okay, while they have huge amount of investments across their businesses, or maybe let's say, as I said, personal assets or real estate, but when they are looking at the financial investments, they always try and create one pool of asset, which is that safety pool of asset or safety pot, which can be used at any point in time, anything, let's say, if you see any unforeseen kind of event. Now, this is the investment vehicle, or let's say the investment pot. When you're creating, you need to ensure that all your investments are actually, going into very, very liquid instruments, investments which are considered to be safer, and something that you can create, liquidity at any point in time when the need arises. So that essentially, brings to the first point, which is your safety pot. Now, let us say that if you have already created one, part of your investments as a safety pool of asset, then whatever is the remaining money, that also can be broken into two parts. So here we call it a core, or a portfolio, which can actually give you that growth, which is something which is in a way slightly boring, because that investment is, you will start, let's say, making it today, you will stay put in those investments over a longer periods of time, but this is the part of your portfolio which will actually create that long-term growth for you in your entire investment. So this is something we call it as core portfolio. And out of this core, beyond this core, let's say if you want to create a small part of your portfolio, which is essentially more like an opportunistic or something, we call it a satellite portfolio, which can give you a lot of excitement, but at the same time, it comes with its own set of risk. In the sense that if I, let's say today, make an investment into a private equity or an unlisted equity investment, those are the investments which will not necessarily be liquid at all points in time. The taxation can work very differently. They may not really, move in line with the markets. So these are the investments which will be part of your satellite portfolio. Now, when you want to create, let's say, a full portfolio from your financial assets, what we have seen essentially is that core portfolio will be the major part of your investment, pool, which could be anywhere between 75 to 80% of your portfolio, and that 15, 20, 25%, depending on your risk appetite, could be your satellite portfolio. Now, in this slide, if you see, what we are essentially doing is, showing you since last, let's say 13, 14 years, how different asset classes have behaved. Now, if you look at, let's say in this, 13-year period, equity out of 13 maybe has, outperformed about 6 to 7 times debt or gold. Similarly, if you look at fixed income or debt investment, they have, let's say, outperformed about 3 times, and gold has outperformed about 5 times over a period of 13 years, which essentially means that no single asset class is giving you the highest or the best return year on year basis. You may see that, equity in 1 year is giving you, let's say, 30% return. But next year, if you see here, classic example, in 2014, we saw equity giving more than 30%, but the next year we saw a negative 4% return. And in that next year, if you look at here, debt has actually returned 9% on your investment. So what we're trying to see or trying to say here is that, it's not necessary that every single, asset class will give you the best sort of returns in all times. So what one needs to do when they're creating an investment portfolio is to ensure that what is important is to have investments across these asset classes. In fact, the next slide that is coming on your screen, this shows that if you look at a lot of these studies, which, a lot of interesting, in fact, people have done, what they say and what the outcome is that 93%, more than 90% of your returns comes from the asset allocation. So if you are in the right asset allocation, irrespective, which instrument, which manager, which product, you will make your major part of your return from the asset allocation, right? So whenever we talk about, let's say, any financial portfolio, we look at 3 or 4 parts and what are really adding up to these returns, right? So I mean, here we're saying that more than 93% of your returns are coming from the asset allocation. The second part, which is the security selection, and I mean, generally, this is the human tendency. You will spend a lot of time in understanding which instrument am I buying, which stock am I looking at, is it the right stock, is it the right manager? But frankly speaking, that is only about 4 to 5% of contribution to your returns. And the major part of your return we've seen is coming from the asset allocation. And the third part, which is again something which becomes very, very important, because if you look at any discussion when you have with any client or any investor for that matter, they always ask you, is it the right time for me to make investments into markets? And especially when it comes to equities, you always feel that market timing is something which is the utmost important. But frankly speaking, again here, if you look at the study, it shows that market timing barely helps you in adding any returns to your portfolio. Maybe if you break the investments into different parts and different time frames, at times you can say that yes, market timing is really helping me. But if you see over longer periods of time, it actually smoothens out, and it doesn't really matter whether you came in today into market, or you came in, let's say day before yesterday when markets were down 3 or 4%. So what we're saying is that it is very important to understand the benefits of asset allocation, and then all the other points will be secondary. Now, if you see this, very interesting, because we always say that one, part is to obviously understand all the data, the valuations, the markets, etc. But then if you talk to any of the gurus in the behavioral finance, and Morgan Housel again is a very, very known personality, he's written a lot of interesting books. If you see what he has to say, he clearly says that personal finance is more about personal than finance, which means that, maybe your requirement could be slightly different than what is my requirement as an individual. And therefore, it's not just about understanding the finance, in that sense, it is very, very personal in that sense, in terms of how would you really create your portfolio, how will you decide what kind of asset allocation is right for you. So just to explain in terms of how does one look at that, maybe a 70% equity is good for me, or let's say a 30% equity is good for me. So to decide that asset allocation, or the right mix of asset allocation, what is important for you to understand is to see A, how different asset classes have behaved over longer periods of time, and B, what kind of volatility, or let's say the drawdown or the downside that you can see in your returns, and do you really have the stomach to bear that volatility in the interim period. Now we looked at that. I mean, equity, we always say, does really well over longer periods of time. But what really happens in those, shorter periods if you break it? And then you need to understand what kind of volatility an asset class can bring. So what I have done here is just to show you different asset classes, be it equity, be it fixed income, be it, let's say, gold. And then in different markets, geographies, US, India especially, how these asset classes have behaved over longer periods of time, okay? So here, if you see, let me focus first on Indian equity markets. So if you see here, we're trying to capture the returns for Nifty 50, which is the main index for the equity markets. So here, if you look at, I'll try and focus on 20-year return, because that's a long, period. And if you see here, if somebody would have started, let's say 100 rupees in 2002, you would have made about 1,830 rupees at the end of October 22. So a 20-year cycle gave you 15.6% annualized return on a year-on-year basis. And that, resulted into, let's say, 1,830 rupees on your 100 rupees investments. So what it essentially means is that, yes, you can make great returns over longer periods of time. But what you see here is that if I just put one single line, maybe, from, let's say, 100 to 13 to 15%, my line will look very smooth. But if you see in the interim, we've seen multiple cycles here, right? So if you look at, for example, let's say 2008, when the financial crisis happened, if somebody would have, let's say, started the investments at this point, okay, and would have seen the markets going down, you would have lost 60% return in a span of 8 months. Okay, so which means if I would have, let's say, put in my 100 rupees at this point, in about 8 months, my investment value would have gone down to 40 rupees, which means I lost 60 rupees in an absolute term, or absolute, return loss is what I would have seen in my returns. So this is where one needs to have that, patience. One needs to have the capacity to look at those kind of losses in their portfolios. And if, let's say, you didn't have that, I mean, uh, capacity to look at those kind of losses, you would have actually exited at a point when markets were at the lowest level. But it took about 2 years to come back to the same level, and markets were again, closer to its earlier peak. So what essentially it means is that unless you can see those short-term volatility, okay, unless you can see those losses in your portfolio, equity as an asset class, you need to be very, very careful. And therefore we always say that if you are a longer term investor, and if you are okay to see those short term volatility in your investments, then equity as an asset class can give you the best of returns. Because if you see in the same time frame, in that same 20-year period, okay, if I look at India Cybex, which is nothing but your fixed income investment, those have given you about 7% CAGR or CAGR returns, which means my 100 rupees when it's invested, and after 20 years, if I looked at, they went up by 4 times, or let's say, 400 rupees went up by 4 times, which is about $400. So which means year on year basis, I made about 7% return. By the same time, if you see the drawdown or the loss that you would have seen from peak to trough was close to about 2.5-3%, which means debt as an asset class will not be extremely volatile. It will give you those steady, straight returns, but in between, maybe at times you can see some bit of volatility. So here is the answer in terms of what kind of asset allocation one needs to have. So you need to understand the underlying risk of the asset class, b, the volatility, which is the risk aspect of it, and the time horizon that you have in terms of your investments. So that will help you to then decide that whether should I have higher equity allocation, or should I be having, let's say, slightly higher allocation to fixed income as an asset class. On the other hand, if I look at, just to touch upon, let's say, gold investing, because gold is again something which is very, very, favorable investment category when we look at the Indian investors. So here, if you see over longer periods of time, let's say 20-year period, gold has given about 8% kind of return. But if I see in rupee terms, it will be slightly better, because rupee has also seen some kind of depreciation on year basis against the US dollar. But gold also has been extremely volatile. So if you see, gold has also given you negative 40-45% return, okay, from the peak to trough, if you look at this entire 20-year cycle in December 15, which means gold is also one asset class which will never be steady, in terms of your returns. It is something which is also considered as a hedge in the portfolio. So we always say that, when nothing is working out, maybe gold as an asset class should be part of my portfolio as a hedge. And usually when we see the HNI clients, they have about anywhere between 3 to 5% of their allocation into gold. But gold also should be considered as, your financial asset, because today, if you see, there are ways and means in which you can invest into gold also in terms of paper investment. And also it makes a lot of sense in terms of liquidity, taxation, purity, because when you buy physical gold, then there are a lot of other, things which come along with it. Okay, so now if I move to, in terms of deciding, let's say, what are the different asset allocation one can look at. So as we understand, in terms of, different categories of asset allocation, it can be ultra conservative, where you have all your 100 rupees into fixed income, or let's say as aggressive as, where you have all your money into either equity or those satellite or alternate, as we call it. In between, you can have a conservative, balanced, or in moderately aggressive profile. Now here, if you see in these different, profiles, so let's say if I look at an example of balance, where generally you say you have more like a 50-50 allocation between equity and fixed income as an asset class. So if you see again, we have looked at here slightly longer period since 2003. till 22. So if you see this kind of a longer period, a balanced profile has given about 14.8% return on an annualized basis. Okay. Whereas if I look at, let's say, a moderately aggressive profile, where you have 65%, let's say, equity allocation and remaining 35% into other asset classes, that has given you about 17.5% return. Now, what is the difference that you see in these two? Okay, so obviously you are taking slightly higher risk because you have a higher allocation to equity as an asset class or alternate, in your moderately aggressive profile. But the 2% or 2.5% of differential return. So on a standalone, if I just look at these two numbers, the difference doesn't really seem very big. But when I see in terms of the absolute number, or let's say in terms of the terminal value. So my 100 rupees, if I would have started in 2003 in a balanced profile, and my portfolio, let's say, was giving me 14.8 or closer to 15% return, my 100 rupees would have become about 2,300 rupees. Okay. But at the same time, if you see a moderately aggressive profile or an aggressive profile where my returns are growing, let's say at 17.5%, my absolute number is far, far bigger. It is about 800 times higher than my previous number in terms of the absolute number. So that is what makes a difference when you look at the terminal value, and that is what tells you that what kind of returns can you make over longer periods of time, even if there is an additional 1 or 2% of extra return you're making on a year-on-year basis. So that is one part in terms of the returns. Now, same thing if we try and look at in terms of the drawdown or the loss that you can see. Okay, so in a balanced profile where we saw my allocation is, let's say, more like a 50-50, my returns went down on a bad day, or let's say from peak to trough is about 28%. Okay, and it says that recovery years was about 1.5 years to come back to the same level. Whereas in case of moderately aggressive profile, where my equity was higher, or let's say pure, equity kind of a profile, my returns went down anywhere between 40 to 50%. And we saw that in the previous slide as well. So what happens is that when you add, okay, a different asset class, which is not necessarily moving in the same direction as, let's say, equity, then your overall volatility will come down. The kind of losses that you can see would obviously be far, far lower. And that is what, gives you some kind of stability in your returns. So this is the graph or the chart which will help you to decide what kind of asset allocation should I be having in my portfolio. In terms of what kind of return expectation should I have, how historically these profiles have done, and what kind of, let's say, volatility they have seen over longer periods of time. So whenever we try and decide in terms of, let's say, creating a policy framework or a policy guideline, we call it, what we need to understand is obviously the highest return is something which I will not necessarily look at. What is best for me is what I'll try and look at, right? And that is where I need to understand that what is the investment horizon that I have on my investment. Am I okay to put this money at work for, let's say, a 5-year period, 7-year period, 10-year period? Or is it that I'm looking at only 1 or 2 year kind of a time frame? Then obviously equity as an asset class may not necessarily be suitable for you. Only if you have a longer horizon is when you should look at equity as an asset class. Second, we looked at the volatility, which is again very, very important, because we saw how equity can erode your returns in the shorter periods of time. But we know as we increase our investment horizon, the line actually smoothens out, right? So volatility is also very important for you to understand how can I handle the short-term losses in my portfolio. 3 is the obviously nature of my income. So in case if I have, let's say, if I'm a salaried, employee, and if I'm getting a regular income through my salary, then it is always, sensible to invest into an SIP kind of a format, which we call it, which is a systematic investment format. So every month you're making some kind of, let's say, investment into your portfolio, which also helps you in a way to smoothen out or to stagger your investment over longer periods of time. When I also look at this, you need to understand that do I have any kind of regular requirements from my investments? Because if you are creating a portfolio for a slightly older person or somebody who's on the verge of retiring, then obviously you will also need some kind of income from your portfolio. So these are some of the things which you need to be very, very clear when you are creating an investment charter, or let's say a investment framework for you. And we, in fact, at our organization puts a lot of emphasis on this. While this sounds very simple, but this is extremely powerful, because this is what can bring a lot of discipline to the investment, and then you will see what kind of outcome it can have. So here, let me just touch upon, some of the important aspects. So obviously we spoke a lot about the policy framework or the policy guidelines. So as a starting point, whenever you are sitting with your advisor, or let's say you're trying to, create a long-term portfolio for yourself, your family, you first need to understand what kind of, objective you have in mind, and what is the investment policy that should look like. So this will define everything in terms of what kind of, pool of assets do you need for your family. It could be a higher, let's say, core portfolio, or a higher safety pot of assets, depending on your requirements, is one will decide the right asset allocation. How much do I need in equity? How much do I need in fixed income? Right? So this is what you need to focus, and this will be part of your investment policy guideline. Then comes, so once I understand that this is my asset allocation I need to work on, then the second point comes where you try and understand more in terms of, should I be investing into passive strategies, or should I be going into more of active funds into my portfolio? Who is the right manager? What is the total cost am I incurring on my portfolio? So those would be the second level of discussion which one needs to understand. In terms of deciding the right, let's say, product or the right manager is also very, very important. Normally what we say to the clients is that, when you're creating an investment portfolio, ensure that you don't overly diversify in terms of the managers. So you have to be extremely careful in choosing the right manager. So here a lot of due diligence is required in terms of understanding the philosophy of the fund manager, his vintage, what kind of research is he doing. So all of that stuff, once you understand, then I think you should have a meaningful exposure to any investment. Don't try and overly diversify. So when I'm creating an equity portfolio, ideally I should be having, let's say, 7 to 8 managers, and then more than that is something which is not really required, right? So this is what is in terms of carefully choosing the right manager or the right security in the portfolio. Then comes the deployment strategy. So here, I mean, obviously we looked at and we saw that it is not really very, very important to timing the market. But at the same time, sometimes you try and see that maybe, 50% is my strategic allocation where I need to be, let's say, in equities. But that 50%, should I be doing today, or should I be staggering it out over, let's say, next 3 or 4 months, depending on where the market valuations are. So sometimes when you're starting afresh, you should always try and take a slightly staggered approach, rather than maybe, let's say, putting all your money on day one. And that also again depends on how the markets are in terms of their valuation matrix, and that is where the deployment strategy can be worked upon for any portfolio. And then the last bit, which is again extremely important. So one is that obviously we all understand that making an investment and making, let's say, an investment charter is quite relevant. But more than that, what is important is to do a periodic review or monitoring your portfolio from time to time. So this is what we always focus on. We say review, review, and review, because what is important is that once I create my portfolio, I can't just forget about it, right? You need to. So while every investment, you have to give certain time to the fund manager, or let's say to the underlying investment, for it to evolve. But what you need to be at least careful in terms of looking at your investment from time to time to see whether how the fund manager is doing, what kind of returns is he generating against the benchmark. Is there anything which I need to look at in terms of, or revisiting my own let's say guidelines which I have made for myself. What is also important to understand is the underlying cost structure of the entire portfolio, because that also is something which will ultimately eat away your returns. And what really matters for you is the post expenses and post tax returns in any portfolio. So today, if you see, for example, there are a lot of these investments which people do into unlisted startups, etc. So while obviously those investments can give you multi-bagger returns, but also you need to understand what is the cost that I'm incurring on those investments, what is the profit sharing or the carry which the fund manager is taking, and what is the tax structure. Because what we've seen is that once you take out all costs and the taxes, then the net returns which remains in my hand, is it something which is really worth looking at that investment. So that is also very, very important for one to evaluate in your portfolio. Now let me just give you some realistic expectations in terms of different asset classes, what kind of return expectation one can have in terms of both pre-tax and post-tax. I'll not get into nitty-gritties in terms of what kind of tax rates, etc. each of these asset classes have. That maybe, in case if somebody wants to really understand that, we can take those separately, or you can write us an email. But if you see, essentially fixed income and equity, they work very, very differently when it comes to taxation. Similarly, if it is an unlisted or a private equity investment, again, taxation would work very differently. So today, if I look at the way, interest rates are, where we are in terms of the interest rate cycle, a debt portfolio, if you're creating, let's say, which is not taking a lot of risk, but it is something which is in between, let's say a AA plus or a AAA kind of instrument, that can give you anywhere between 7 to 8.5% kind of returns. This would be your pre-tax return. When I look at my post-tax, post-free, etc., this number could work out to be somewhere around 6.5 to, let's say, 7.5% or so. So this is a realistic expectation if one is starting to create a fixed income portfolio today from, let's say, a 3-year perspective. Similarly, on the equities, as a thumb rule, if you see, there are different ways in which one, can look at. So normally people say that maybe if I look at my equity portfolio, it is the nominal GDP of a country plus, let's say, 200 basis points. Or another way to look at is that, let's say, what is the corporate earnings growth rate is what I can expect, at least in terms of my equity returns. So today, if I look at even in terms of the way India, corporates are growing in terms of their earnings, it is anywhere between, let's say, 12 to 14 or 14 to 15% kind of range. And that is what is the realistic expectation from a longer term perspective if you're creating your equity portfolio. So here also, earlier there was no tax on equities, but today we all know that there is a tax element as well. So the post-tax returns could be anywhere between, let's say, 10 to 11.5 or 12%. Coming to private equity, so as I said, the upfront number looks very encouraging, because if you see any private equity fund, your expectation has to be at least, let's say, 20 to 25%. But when I pull out all my cost structure, the taxes, the carry, after all of that, my post-tax returns will be somewhere between 15 to 18%. So this is what the expectation one can have from the private equity investment. Similarly, today you see a lot of interesting opportunities coming on the fixed income side, which could be a structured debt, venture debt. Those kind of opportunities can also give you returns in double digit. It could be anywhere between, let's say, post-tax between 10 to 12% is what one can expect. So these are some of the broad ranges one can have from these asset classes. And then depending on what kind of allocation do I have into each of these asset classes will actually determine my overall return on the portfolio. So depending on, if you're creating a very aggressive portfolio having only, let's say, equity and private equity, obviously your returns would be upwards of 13, 14%, right? Or if somebody is having a conservative profile with a higher allocation towards debt and maybe small allocation towards equity, it can give you anywhere between, let's say, 9 to 10% overall returns on the portfolio. So this is something which is very, very important, because what we've seen, is the historical, let's say, returns, but going forward, what one can expect, from the portfolio is more important and more realistic. Okay, now, if you look at another interesting quote, which is from Warren Buffett. So he says that I don't really look to jump over 7-foot bars. I look for 1-foot bar I can step over, which essentially means that you try and take smaller steps and then, sort of evolve rather than taking. And again, I think what I also feel is investing is not, it also evolves over a period of time, right? It's not that you can start on day one with the perfect portfolio and you'll always stick to it, because there could be multiple things in terms of your own situation which can change. Sometimes, you have a liquidity event which gives you a large sums of money in the life of your, let's say, a portfolio. So a lot can change over a period of time. And depending on your situation at that point in time, obviously your asset allocation, your investment, guideline, your investment framework can also change. So here, what we're trying to see in this slide is the entire universe. We looked at equity, fixed income, let's say gold, etc. Now, within these asset classes, if I break fixed income also for that matter, fixed income can be, credit investing, which is very, very high in terms of maybe returns, but at the same time, in terms of risk also, it can be sitting in a very different quadrant compared to, let's say, my fixed deposit in the bank, or let's say my debt mutual funds in my portfolio, right? So what we need to understand is that in terms of both risk and return, okay, how the positioning will be for each of these asset classes. And then I can try and choose that, if I need, let's say, returns which are way higher than most of the other asset classes, but at the same time, I'm okay to take that kind of a risk, then obviously I can be, I mean, significantly, having a higher allocation towards a private equity or a VC or a credit fund. Similarly, if you see your debt portfolio, or let's say your debt, I think we've understood. So let's say, I mean, if I look at my REITs, InvITs, or let's say gold portfolio, which can be something in between. So it will give me, slightly better returns than my usual fixed income portfolio. At the same time, risk will be slightly higher. It will not be significantly higher like what we can see in my equity, or let's say in my unlisted portfolio. So this is also very important to understand the positioning of your underlying investment, and then decide what kind of allocation one can have. Now, this is one slide where, again, I mean, we looked at that chart where we saw the asset allocation actually plays out an important role. We always say that, time in the market is more important than timing the market, right? Sometimes we say, okay, fine, if you look at this chart, for example, this is a nifty chart which we are putting from 1991 to 2002. Now here, if you see, obviously there are multiple, ups and downs. You see, if I click on the next point, it shows you there have been multiple events which have unfolded, okay? For example, if you see here in 97, we looked at Asian financial crisis. In 2000, we saw a dot-com, bubble, which got busted. In 2008, again, we saw financial crisis unfolding. 2000, we looked at COVID. So a lot of these things, obviously, we'll see, your market returns going down very, very sharply, maybe the short span. And we saw that 60% kind of erosion, in our previous slide. But what is important for us is to see over a longer period of time, okay? If you see since 91 to 2002, 22, markets have given you here 13.5% return annualized year-on-year basis, right? So when I say year-on-year, it is not that every calendar year you'll see 13.5%, but when I see my overall return, the terminal value, and when I see my annualized number, 13.5% is what I have made. Similarly, we looked at on a 20-year period, market had given about 15.5% return, right? So what is important for you to understand is that you have to be in that asset class to make the returns which it has given over longer periods of time, right? Not necessarily that every time I'll decide that should I be investing today, and maybe 6 months down the line again I revisit my investments. Do I need to do a profit booking? Maybe those discussions can happen on a tactical basis, but not necessarily that strategically you have to change every asset class from a shorter term perspective. Otherwise, markets will never give you this kind of return. Now, since we're on this slide, again, it's very important for me to mention here. What happens is that normally when we decide, let's say, choosing a fund, okay, especially on the MF side, we look at what kind of return the mutual fund manager has generated over, let's say, last 3-year, 5-year, or 10-year period. And basis that we can decide that maybe this is the right investment for us. But when you see, and in fact, there was a very interesting study which had been done by Morningstar recently, and what they came across is that the fund manager return was very, very different from that of an investor return, because what happens is that the fund manager is seeing his return, let's say over a 10-year cycle where he's fully invested, right? But when I'm looking at my return as an investor, I may not be fully invested in that 10-year cycle with him the way he is. At times, you'll pull out your money in between, maybe you've added at different points in time. So your returns could be very, very different than the fund returns. And that is the reason why we always say that you have to be in the fund, you have to stay put for longer period to see the actual long-term returns. Very quickly, so this is what I think I meant when I say tactically, sometimes, you can be slightly different in your allocation. So what does it mean? So let's say on a balanced profile, if you decide to have 50% allocation into equity, all right, but because let's say markets are trading at a very, very higher valuation, so let's say if your P valuations are 17, 18 times, your price to book, let's say if is beyond 3, we normally say that markets don't sustain those kind of valuations, even if you look at historical a trend. So sometimes, depending on the situation, the shorter term call can be underweight, overweight, but those should be again in terms of very tight range in which you should play. So let's say if I have a 50% allocation to equity, I can say that even if I'm bearish, I can go down to 40, but never take a binary call. So 50 should never become 0, and 50 should never become, let's say, 100. So if you take that kind of a binary call in terms of 0 to 100, then obviously your portfolio can look at very, very differently in terms of the returns, and the risk also that you take is very different. So ideally what we say is that you should take those tactical calls, but then stick to two things: A, in terms of the range in which you can play, and B, in terms of the timeline within which you will play those calls. So very quickly now, I think I'm just coming towards the end of my presentation. So compounding is one thing which we always insist on when we talk about investing. So whether it is equity, fixed income, gold, any investment for that matter, or even real estate, what we've seen is that only when we have very, very long-term horizon, compounding is something which really helps you to grow your assets. So today we looked at in terms of our equity returns, we were somewhere around 15 to 16% on a 20-year cycle. My 1 crore actually returned 18 times, 19 times, to close about 18, 19 crore over 20-year period. You see fixed income gives you 7%, but at the same time inflation is also something which is very closer to that number. So you don't really beat inflation if you only create a fixed income portfolio. So to beat inflation, you have to have growth assets in your portfolio which can give you slightly better returns, and then you don't really lose your money in terms of inflation numbers. Gold, on the other hand, if you see, so we looked at in dollar terms, gold had given about 8% return. But if I look at in terms of rupee over a 20-year period, gold has given about 11.5% return to me. So my 100 rupees, or let's say my 100 crore, or let's say 1 crore rupees, has actually given me about close to 8.5, 9 crore in my gold over a 20-year period. Okay, now when you talk about compounding, okay, so compounding, we all understand that as you have a longer horizon, the compounding actually starts playing a big role. Okay, so here we're trying to just put 2 or 3 different examples and see how compounding can really make difference in your overall portfolio returns in terms of the absolute value. So let's say if somebody starts investing at the age of 20, and every year, let's say you're making 1 lakh rupee of investment, okay, till the age of 40. So you're making 20-year investments starting at the age of 20 and putting that 1 lakh rupee every year on year basis, right? And let us see that your portfolio grows at 10% compounded return. At the age of 60, okay, your portfolio value would be about 4.24 crore. By the same time, if somebody is starting at the age of 30, okay, making that same 1 lakh rupee of investment on a yearly basis for the 20-year period, which is 30 till the age of 50, okay. But when I look at my portfolio value at the age of 60, my portfolio value is only 1.63 crore. So what essentially has happened here? I just put the same, amount in terms of my portfolio, but my portfolio got a lot of time in terms of growth, because from 40 to 60 is the additional 10 year is when my portfolio has grown. Whereas in this case, I was already at the age of 50, and when I wanted my assets, or let's say my portfolio at the age of 60, it only got that additional 10 years in terms of growing my value. So my portfolio actually grew only to 1.63 crore. So whenever we say start early, this is what we mean in terms of the compounding. It can give you, real surprises if you see what kind of, difference it can make in terms of the terminal value. In fact, if you look at here, on the other hand, we're just trying to see if somebody, let's say, start with slightly, higher upfront investments. So instead of, let's say, 1 lakh, if you start with 1.1 lakh, and if you take the same investment frequency of, let's say, 30 sort of, year, you see here it is only giving you 1.81. But even if I start with a higher upfront, the difference is not that significant. But here we saw, when we started at the early age, the difference which it made to my overall, portfolio value was a significant higher number compared to what I saw in the other case.
Rama, hi.
Yeah,
I think we'll have to wrap up now.
Yeah, just last, or maybe I can stop, because this is again on compounding only. So maybe very quickly, I just wanted to highlight on last, 1 or let's say 2 minutes. So here, if you see in terms of, what actually goes into when we create a client's portfolio, we work, very closely with the clients. So obviously you always have your family and our relationship team. But at the back end, if you look at, there's a huge, there are multiple teams which are working 24/7 on the investment on your portfolio. And that is what actually goes into the client's recommendation. Today, again, if I look at, what really goes into your portfolio is something which goes through the entire funnel, where we look at multiple opportunities in the market, a lot of due diligence happens, and then we arrive at the, let's say, 8 or 10 recommendations which we make into your portfolio. And that also goes into constant monitoring. So this is essentially what I had to speak today. If there's any question, maybe I can just quickly take them. Otherwise, you can always write to us and we will come back to you. Thank you. Thank you, everybody.
Thank you, Rama. For all the participants, I've also left my email ID on the chat box. In case you would like to reach out to us, please do so. I think Rama has done a great job in just dissecting how there are small aspects that one needs to maintain in terms of discipline and not trying to chase high returns if it doesn't suit you. Of course, we can have personalized discussions later on whenever somebody has a requirement. But yeah, thank you, Rama. Thanks for giving an insight.
Thank you. Thank you so much, Akshat. Thank you, everybody. Have a good day. Bye.